Welcome to Finance Orbit, and if you're here, it means you're ready to take control of your financial future. This is the only video you need before making your very first investment. The stock market can feel like a complex, intimidating place. But at its core, it's not scary. It is simply one of the most powerful engines for generational wealth creation available to the public. In this video, we're going to clearly and briefly cover the 5 foundational pillars for every beginner. Let's start with the basics. Pillar 1. What is a stock, really? A stock, or a share, is literally a fraction of ownership in a company. When you buy one share of, example company, use an animation of a well-known logo, you become a tiny part owner. You are a shareholder. Why does the company sell this ownership? To raise capital, money, to fund expansion, research, or operations. Where do you buy it? The stock market is divided into 2 parts. The primary market is where a company sells shares for the very first time. This is known as an IPO, or initial public offering. But where you and I trade every day is the secondary market, the place where investors buy and sell existing shares from each other, through platforms like the Nasdaq or the NYSE. When you invest, you are seeking a return. This typically comes from 2 sources: capital appreciation, which is the increase in the stock's price, and dividends, which are periodic payments of the company's profits directly to shareholders. This is the most important part. Pillar 2, your investment philosophy. Before you select a stock, you must define your approach to risk management. Many beginners confuse trading with investing. Trading is speculative, short-term, and relies on frequent buying and selling to capitalize on market volatility. Investing is long-term. It's the strategic allocation of capital, expecting a positive return over 5, 10, or 20 years. For beginners, we recommend the philosophy of long-term, patient investing. Why? Because over any 15-year period in history, the broad stock market has always generated a positive return. This discipline helps you ignore the daily noise and harness the power of compounding. Pillar 3. The non-negotiable rules of risk. Rule number 1. Never, ever invest money you need in the next 5 years, or money required for basic living expenses. This must be disposable capital. Rule number 2. Avoid margin trading, which is borrowing money from your broker to buy stocks, until you are a seasoned professional. The risks are magnified exponentially. The single most important concept in beginner risk management is diversification. This means you never put all your eggs in one basket. If one company fails, your entire portfolio is not wiped out. This brings us to Pillar 4, your first investment vehicle. How do you achieve that essential diversification easily? The answer is often the exchange-traded fund, or ETF. An ETF is essentially a basket of many different stocks or bonds. By buying one share of an ETF, you instantly invest in hundreds of underlying assets. For example, an S&P 500 ETF lets you own a tiny piece of the 500 largest companies in the US. For a beginner, an ETF is generally the more prudent, risk-adjusted approach. It requires far less research and minimizes the impact of any single company's poor performance. It's the smart way to get market exposure immediately. Pillar 5. Your step-by-step action plan. You're ready to start. What are the 3 practical steps? Step 1. Open a brokerage account. A broker is the licensed financial institution that facilitates the buying and selling of securities. Look for a broker with low or zero commission fees, user-friendly tools, and a strong regulatory history. This account is your direct gateway to the market. Step 2. Fund your account. Start small, but be consistent. The true magic of investing lies not in the size of your first deposit, but in the regularity of your contributions. We advocate for dollar-cost averaging, investing a fixed amount of money at regular intervals, regardless of the stock price. This removes emotion and averages your cost over time. Step 3. Make your first strategic purchase. For this very first time, focus on buying a low-cost, broadly diversified ETF. Don't chase trends. Click the Buy button, and you have officially become an investor. Congratulations! I want to leave you with one final, crucial thought. The only way to truly lose in the long-term stock market is to panic sell during a correction. The market will fluctuate. It will have down days. Your ability to remain disciplined, stick to your plan, and continue investing through those periods is the defining trait of successful investors. We've covered the fundamentals, but this is just the launch point of your financial journey. In our next video, we will dive into fundamental analysis, how to evaluate a single company's health before you buy its stock. If you found this professional,